This week is about spending on long-term assets and shorter-term benefits. Capital expenditure is spending on longer-term assets, and incurring expenses, current period expenses, current year expenses is what we do when we're spending money that isn't on longer term assets. Let's have a look at something we've seen before. This from last week. It's the first schedule we looked at. This was when we're making sales. The reason I do it is we need to think about a balance sheet, a cash flow statement, and an income statement and the differences between them. And if we start from something we believe to be true, then it's easier to see that what we're doing is just fitting into a pattern and there's nothing radically different. It's just variations on the theme, generally to do with long and short term in this context. So accounting for, let's say, capital expenditure and spending on current period costs, let's call it. And let's change some of these rows. So this will be long-term assets, net book value. Net book value is just the amount we're showing this kind of asset for in our balance sheet at the moment, taking account of what we originally spent and what has happened between then and now, which is passing of time quite often. So there may be some receipts. Let's add to the receipts payments, and let's have minus payments. So let's put them in a bracket as well. So payments are outflows, and then there will be an inflow or outflow for the period. And in all these cases, there'll actually be outflows. Inflow, outflow for the period. And then there will be expenses, and then a reconciliation, and that reconciliation, when we've got less cash than we might expect, would be an increase in brackets, increase in long-term assets. Okay, let's remove these shorter term items. Let's say, first of all, we buy a capital asset, let's say a super duper lawnmower for cash. And that costs us, let's say, 8. So we spend 8 on a state-of-the-art solar-powered, very excellent lawnmower. That's a payment of 8 in the current period. Let's copy these formulas down. So our payment 8. So our cash has gone down to 2. Is that an expense? No. That's the whole point. The capital asset, let's say we buy it on the last day of the year, is a long-term asset. So it will have value for several years. So rather than charging that amount to the income statement, we're going to recognize an asset on the balance sheet. And let's say it's the last day of the year, so we're not going to have any timing to deal with. Okay. Now, our profit and loss is none because we have no income and no expenses, but our cash flow is an outflow. So why is this so? It's because our long-term assets went up, reflecting, we could say, some cash we spent that went onto the balance sheet instead of going into the income statement. So buy capital asset for cash and cash goes down. Instead of expenditure being incurred straight away, we've got an asset being created. Now let's say, so that might be buying the lawnmower. This next part might be paying wages. So let's say incur current period expenses. And let's say that's 1. So cash goes down by 1. This is another payment. This time we're recognizing an expense in the current period. So our expenses, our expenditure in the current period is 1. Are there any differences? So let's first say we've got a loss for the period. We've got a cash outflow for the period. So loss for the period 1. Cash outflow for the period 1, because there's no items in cash flow that are not in the income statement. There's no items in the income statement that are not in cash. The single item, namely wages paid in the current period, are in both. So there's no timing differences between the loss and the cash outflow.